The dangerous part of your 50s is that you can look successful right when your margin for error is getting smaller. Picture a man named Mark. He's 53. He has a steady job, a house, a 401k, maybe a truck payment, maybe a kid who still needs help, and a plan to work a few more years. From the outside, Mark looks fine. But the biggest traps in your 50s usually don't look like disasters. They look like normal life. A payment here, a repair there, a little help for family, a job that feels secure, a health bill you plan to think about later. Each one seems manageable by itself. The problem is that retirement doesn't care how normal the payment looks, it only cares how much runway it takes. So this video isn't really about 7 random mistakes. It's about one question. Does this choice protect your retirement runway, or does it quietly steal years from it? We're going to keep coming back to Mark's 12-year meter, because in your 50s, the number that matters isn't only your salary, your home value, or your account balance. It's how many options those things still buy you. The first clue is hiding in the Federal Reserve's household survey. Among non-retirees aged 45 to 59, 74% had a tax-preferred retirement account. 31% had a traditional pension, but only 43% said their retirement saving was on track. Across all non-retirees, only 35% said they were on track. That gap is the whole story. Having the account isn't the same as knowing it can carry the plan. And the same Fed survey found that 65% of adults aged 45 to 59 had a major unexpected expense in the prior year, higher than the 59% figure for all adults. The common categories were painfully familiar: vehicle repairs, home or appliance repairs, and medical expenses. That matters because the 50s are still a paycheck decade for most households. In the Fed data, 84% of adults aged 45 to 59 had labor income. For adults 60 and older, that fell to 44%, while Social Security and pensions became much more common. So the bridge from Mark's paycheck life to retirement life is real. If that bridge is loaded with payments, the runway gets shorter. The first trap is the peak income illusion. This is when your biggest paycheck makes the household feel safer than it really is. The salary number is visible. The true surplus is not. True surplus is what remains after fixed costs, debt payments, family support, and retirement catch-up have all taken their claim. For Mark, the useful question isn't, do I make good money? It's, how much of that money is still free after the first claims? A 6-figure income can still produce a tiny runway if the check is already spoken for. Salary impresses people. Surplus buys choices. And this is why the word trap can be a little misleading. Mark may not feel trapped. He may feel productive. He may feel proud. He may feel like he's finally earning the money he worked 30 years to earn. But if every raise becomes a bigger payment and every bonus disappears into yesterday's obligations, the household gets louder while the runway gets quieter. That's where the first reveal lands. In the same Fed survey, only 55% of adults aged 45 to 59 said they had a 3-month emergency fund. That was the same as adults overall, but far below the 71% figure for adults 60 and older. And 30% of adults said they couldn't cover 3 months of expenses by any means. A man can be employed, housed, and still have a thin runway. This is why the 50s are so unforgiving. The system does give catch-up room. In 2026, the 401k employee contribution limit is $24,500, with an $8,000 catch-up for many people age 50 and older, and a higher catch-up for ages 60 to 63. But catch-up room only helps if the household still has surplus to use. So the catch-up number isn't a moral score, it's a capacity test. If the contribution room exists but the month can't reach it, the missing piece isn't discipline alone. It may be housing, debt, family support, or risk that never made it onto the plan. The runway meter forces that hidden gap into the open, while choices are still available and the fix is still smaller. That's the moment worth buying early. The second trap is debt that pretends to be stability. A house can make you feel wealthy. A clean truck can make you feel established. A credit card balance can feel temporary. But when retirement is close, the question changes. It's not, can I make the payment this month? It's, does this payment still exist when I want work to become optional? The Fed housing data shows why this can be tricky. Homeownership was 76% among adults aged 45 to 59 and 83% among adults 60 and older. But 64% of homeowners had a mortgage. The median mortgage payment was $1,600, and for recent movers it was $2,300. Those payment numbers aren't age-specific, so don't overread them, but they show the shape of the trap: an asset on paper, a monthly claim in real life. Put that on Mark's runway meter. The house may protect him long-term, but the payment still takes the first bite of the month. Then the car payment takes another bite, then the card minimum, then insurance, then property taxes. By the time retirement savings gets its turn, the month may already be tired. Credit cards add another layer. Among adults aged 45 to 59, 86% had a credit card. Among those cardholders, 52% carried a balance at least once in the prior year. That works out to 45% of all adults in that age group. This doesn't mean everyone is drowning. It means the payment trap is common enough that a retirement plan should treat it as real. And the visual-only proof is even sharper. The average card balance increase since January 2024 was much larger for people who said they were finding it difficult or just getting by than for people living comfortably. That's the debt spiral in miniature. The people with the least room lose the most room. So the debt question in your 50s isn't just, what's the balance? It's, what's the debt-free date? If that date sits past the retirement date, the payment doesn't disappear when the paycheck does, it walks into retirement with you. That one shift changes the conversation. A $600 car payment doesn't sound like a retirement problem if Mark can afford it today. But if the payoff date is 4 years after the date he wants to slow down, the payment becomes a retirement timing decision. Same with a card balance, a HELOC, or a loan taken out to just smooth things over. The calendar tells the truth that the monthly payment hides. The third trap is harder because it doesn't feel selfish. It's becoming the bank of dad. Pew found that 44% of adults age 18 to 34 with a living parent got financial help from a parent in the prior year. 59% of parents with young adult children said they helped, and 36% of those helping parents said it hurt their own finances. On screen, a $500 monthly support cap can show how quickly love becomes a line item. The point isn't, don't help your kids, that's too simple, and it misses the emotional truth. The better rule is, help with a cap, an end date, and a plan. Mark can say, I can help with $500 a month for 6 months while you stabilize. That's different from becoming an invisible second rent payment for the next 5 years. The math is simple enough to remember. A $500 monthly promise for 6 months is $3,000. A $500 monthly promise that drifts for 5 years is $30,000 before any investment growth, taxes, or stress enters the story. The issue isn't generosity. The issue is whether the help has a finish line or whether it quietly becomes another claim on the 12-year runway. Family support isn't only money either. The Fed found that 23% of adults aged 45 to 59 provided care to someone. Among prime-age adults, caregivers were more likely not to be working than non-caregivers, and daily caregivers were more likely still. Care is love. Care is also time. And time is one of the things a 50s retirement plan can't always replace. Now Mark's 12-year runway has 3 pressure zones: debt, family support, caregiving. None of them makes him irresponsible. That's the uncomfortable part. These are normal obligations for responsible people, but normal doesn't mean harmless, and that leads to the midpoint turn. The midpoint question is this: what if the income stops before the plan says it should? A lot of 50s planning leans on one sentence: I'll just work longer. Working longer can absolutely be part of the plan, but it shouldn't be the only plan. Urban Institute research found that about half of full-time, full-year workers who were ages 51 to 54 experienced an employer-related involuntary job separation after age 50. That doesn't mean half of all workers are forced to retire. It means the assumption deserves respect. The Fed survey also showed layoffs rising from 6% in 2024 to 7% in 2025. Small move, big reminder. The paycheck has risk. So Mark needs 2 plans. Plan A is work until 67. Plan B is, what happens if work ends at 61, or 59, or 63? The man with Plan B sleeps better even if Plan A works perfectly. The man with only Plan A is asking his employer, his health, and the labor market to cooperate for 12 straight years. That doesn't mean Mark should expect the worst. It means the plan should survive a version of reality that's less polite than the spreadsheet. If the runway only works when income continues without interruption, debt falls perfectly, health stays quiet, and nobody in the family needs help, that's not a plan. That's a wish with numbers around it. Health is the next risk hiding under the work longer plan. Fidelity estimated that a 65-year-old retiring in 2025 may need $172,500 for healthcare expenses in retirement. That's an estimate, not a personal bill, but it gives the right signal. Health costs aren't a side issue, they're part of the runway. And there's a second line in the fine print: Medicare generally doesn't cover long-term custodial care. Fidelity's estimate also excludes long-term care. So a man who says Medicare will handle it may be mixing 2 different things: health insurance and care needs. One can help with medical coverage, the other can become a household freedom problem. The useful move isn't panic, it's a healthcare bridge. If income stopped for 6 to 12 months, what pays the premiums? If work ends before Medicare, what's the coverage plan? If a care need appears, who's expected to solve it? These aren't cheerful questions, but they're control questions. Control is the whole point of this video. Then comes the trap that often catches smart people, not careless people: the confidence. By the time a man reaches his 50s, he may have made thousands of decisions, managed people, bought homes, negotiated deals, and trusted his judgment. That's useful. It's also exactly what a bad pitch can lean on. The FBI's 2025 Internet Crime Report shows the size of the reported risk for older adults. People 60 and older filed 201,266 complaints with $7.748 billion in losses. The average loss was $38,500, and 12,444 complaints reported losses over $100,000. This is reported internet crime, not all fraud, but the number is big enough to take seriously. The firewall is simple. Core retirement money is not casino money. Big withdrawals need a cooling off period. Any wire, crypto transfer, or private investment gets a second person check. And if the pitch needs secrecy or urgency, the answer is no. The goal isn't to prove you're brave, the goal is to keep control. The final trap is timing. Retirement isn't one switch, it's a control panel. Social Security can start as early as 62, but for people born in 1960 or later, full retirement age is 67, and claiming at 62 means a 30% reduction from the full retirement benefit. Many retirement account owners also face required minimum distributions starting at age 73. None of that tells Mark what to do. It tells him timing has consequences. This is why the final years before retirement deserve a map, not a guess. Work date, Social Security age, withdrawal order, taxes, health coverage, and debt payoff all move different levers. Pulling one can move another. A bigger check later may help. Cash needed now may matter more. A tax bill in the wrong year may surprise you. The script can't give personal advice, but it can give the right question. Which lever are you pulling, and what else moves when you pull it? So here's the payoff. You don't need to solve your whole retirement today, but if you're in your 50s, you need 6 numbers. Number 1, true surplus, not income, surplus. Income minus fixed costs, debt, family support, and retirement catch-up. Number 2, debt-free date. Number 3, emergency runway, measured in months. Number 4, family support cap with an amount and an end date. Number 5, healthcare bridge, especially if work ends before Medicare or a care need appears. Number 6, timing map, with Social Security, retirement account withdrawals, and required distributions all visible on one page. This is the audit, not a perfect retirement plan, not a promise, not advice about exactly when to claim, sell, save, or withdraw. It's a decision lens. If a number protects options, it strengthens the runway. If a number depends on everything going right, it needs a backup. If a number is blank, that's where the next conversation starts. Now put Mark back on the screen. He still has the job, he still has the house, he still has the 401k. Nothing about the outside picture has changed, but the inside picture is clearer. If the true surplus is positive, the runway gets stronger. If the debt-free date sits before retirement, the runway gets stronger. If family help has a cap, if health has a bridge, if timing has a map, Mark isn't just hoping the next 12 years behave, he's protecting options. That's the real lesson. The goal in your 50s is not to look rich, the goal is to protect your options. Because the man who wins this decade isn't always the man with the biggest income, it's the man who keeps the most control. If this helped, like the video, comment with the trap you think catches the most men, and subscribe for more plain English money breakdowns. Thanks.